You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball, and my co-host John McEwen. In this week's episode, we'll be discussing Aviva, Brewin Dolphin, Britvic, AO World and Dell. So John, do you want to kick us off with Aviva first?
So the news from Aviva, Britain's largest composite insurer spanning life and general cover. Third quarter trading update. The trading for the 9 months to September the 30th was resilient. Sales in the UK and Ireland in the life business rose 40% to £9.2 billion. But overall, there was a 13.8% decline in the value of new business written by its life insurance, which stood at 714 million in the first 9 months of the year. And that was partially mitigated by the modest 1.4% growth in the general insurance premiums, which hit 7.1 billion. And the new chief executive, and this really grabbed the headlines, was the dividend cut, which will be cut by a third. And she also mentioned that, or indicated that the French and Polish side of the businesses may be sold, and they're reducing their exposure in Italy, Turkey, China, and India. So it's really a focus on the British Isles, so UK and Ireland, and the Canadian side of the business. The dividends are due to grow going forward, but at a lower level, low to mid single digits over time. So that was a summary of the update coming from Aviva. Any thoughts on that, Sam?
So the update looked fine. I don't know if you were planning to get into it later, but I thought compared to historic levels, the business looked cheap.
Yeah, so at the moment, the price to book is about 0.76 compared with the 10-year average of about 1.1.
It's actually trading at a historic PE of 5, but the reason that is so low is because the crisis has meant that any assumptions that were made about insurance claims were just completely off. So the asset pool shrank due to stock market crashes. It's Aviva's subject to regulatory requirements for its liquidity and solvency. So it's had to then start selling stuff. Changes to the cash coming in and flowing out of the asset pool had the potential to breach those requirements. So the reason it's so cheap is because it's so difficult to value. And looking at the balance sheet as well, that was very, very difficult to understand, I thought, just because it's got a lot of stuff on there. So it's because it's an insurer, it's got the float on there. So it makes it very difficult to value. So for me, it just goes straight in the too hard pile, really.
Yeah. No, I mean, I think that's reasonable. And I suppose one of the reasons a lot of people would be buying this is as an income play, really.
I mean, the prospective dividend yield, even after the cut, it's still about 7.5%. So if you think they can sustain that, which you'd expect they would if they've just cut it, that is good as an income play. What's the share price been doing?
So the share price, it's hovering around about £3.20. It got to a low of about £2.10, £2.11, and that was after the crash in March back with COVID. So since then, it's had a fairly decent recovery, but we're not at sort of pre-COVID, pre-crisis levels when it was £4.20 a share.
What do you think of the business then?
To be honest, I don't think I understand the business well enough to be able to sort of form an opinion on it or make an investment case for it. I think it's one that I'd be looking into further. And I do actually already have an insurer as part of my portfolio, but it's not something I'd probably revisit it, I think, and spend the next couple of weeks just reading a bit more into it and exactly how the business is structured and how it works.
It's interesting you say that because I've got a similar thought in that I also don't think I understand it well enough. But for me, it just didn't look attractive enough. Besides the dividend, it didn't look attractive enough that I'd want to go in and spend more time looking into it. Because it didn't look like the performance was particularly stellar.
No, but I suppose it depends whether you want part of your portfolio to have some income. And would you see it maybe as sort of an income stock as part of the portfolio? Or
I think if I wanted an income stock, I think there's better companies
that
are easier to understand as well.
No, that's fair enough. And with Prudential that I hold, one of the things that I thought that was quite attractive about that insurer was it had quite a lot of exposure to Asia, and it had sort of potentially more growth there rather than purely as a sort of a domestic insurer.
On your watch list, potentially,
but yeah, one I'd read about more, I think.
Okay, on to our next company. Should we go on to Brewin Dolphin next?
Yeah, Brewin Dolphin.
Brewin Dolphin have just released their full year results for the year ended 30 September 2020. So for anyone who doesn't know, Brewin Dolphin is a wealth manager. So it's quite a similar business to Rathbones, which we covered fairly recently. So they announced strong total discretionary fund inflows of 2.8 billion, total discretionary net inflows of 0.9 billion, which represented an annualized growth rate of 2.2%. Total funds increased to 47.6 billion, which was up 15% since 31 March 2020, although that's probably mainly due to the appreciation of stocks and shares and funds in that period rather than an influx of new clients. Excluding funds from acquisitions of 2.7 billion, however, total funds were broadly flat year on year. Total discretionary funds increased to 41.2 billion, including funds from acquisitions, with positive net flows more than offset by negative investment performance in challenging markets. The total income for the period increased by 6.6% to £361 million, and that included 19.8 million from recent acquisitions. The income was higher in the second half of the year due to higher commission and fee income due to markets being back at higher levels. Financial planning income grew 20.4%, which is an increase in the growth rate as it only grew at 12.2% in the prior year, and it now stands at 33.1 million. Profit before tax increased 4.3% to 78.2 million. Diluted earnings per share were 20.4p a share. They announced a final dividend of 9.9p a share, which takes the total for the year to 14.3p a share. CEO Robin Beer said, "Our objective is to help people build financially sustainable futures whilst achieving peace of mind. This could not have been more welcomed by our clients in a year which saw markets fall during the initial peak of the COVID-19 pandemic. Whilst markets have recovered from those levels, continued volatility remains a likelihood until the pandemic is under control. What is evident is that we could not have achieved our success this year without our values-based decision-making and our client-centric culture. Adapting quickly to remote working enables us to continue to deliver against our strategic objectives and delivered a set of resilient results. Looking ahead to financial year 2021, we're prioritising our digital agenda so we can innovate and explore ways to improve client and advisor user experiences. Our focus will also be to implement our new custody and settlement system, which will enable us to realise both operational and technology benefits. Our sector continues to have structural growth dynamics, and we intend to benefit from these by enhancing our distribution capability through our direct and indirect channels. These priorities will enable us to maintain relevance through both our propositions and user experience, become more efficient through improved processes, and ensure we are well placed to capture growth opportunities in challenging markets." I should mention as well that diluted earnings per share was a 4.2% drop on the prior year. Profit before tax was a 4.3% increase in the prior year.
It's probably better than you might expect in the circumstances.
Yeah, I thought it was a decent set of results. Obviously, I think with a wealth manager, the key figure is assets under management, because that's what they're charging a lot of their fees on.
Yeah.
And given the amount of volatility in the market, the fact that funds under management hasn't decreased, I think it's a positive sign.
Yeah, I mean, the total funds climbed from 45 billion a year earlier to 47.6. So exactly. In the circumstances, it's not bad at all.
I think it looks like a quality business, to be honest. I mean, it's the same. We said it when we looked at Rathbone, so I won't go into it too much again. But I think a lot of the wealth managers listed on the FTSE, they look very attractive.
And again, you don't think that they're sort of ripe for disruption from a lot of the passive companies, like whether it's Vanguard, I suppose, being the most obvious?
I don't think so.
No.
I mean, it's the same discussion we had before. I think there's always going to be a market.
Yeah, and then, I mean, possibly more for the millennials, but you've got sort of the free trading platforms coming through, some of which are app-based. You don't think they're, again, going to be competitors or direct competitors to wealth managers like Brewin Dolphin?
Depends how people do on it, doesn't it, really? I think if people go on it and lose money, they're probably more likely when they're a bit older and they've got more money to go to a Brewin Dolphin.
Brewin Dolphin, yeah. No, that's fair enough. I mean, I suppose I probably quite like them as companies. Myself, I don't use one, but I can see why, and that the brand, I think there's a lot of trust in these brands. We've mentioned Hargreaves Lansdown, AJ Bell as well, being some other bigger players. But I suppose they're more in the online brokers compared to just sort of general wealth managers.
Yeah, so I don't know if AJ Bell and Hargreaves are really direct competitors to Brewin Dolphin. I think Brewin Dolphins, the companies you look at for comparison, it's probably Rathbones and Schroders, really.
No, I'd agree with you there.
But in terms of the valuation, it's got a market cap of 823 million. It's trading at a price to earnings of 13, and the dividend yield is 5.3%.
On paper, at least, it's quite attractive.
It is attractive, yeah. It's not the kind of growth that'll blow your mind, but revenue's grown in the past 5 years, revenue's grown from 280 million to 359 million. And in that period, adjusted earnings per share, just because then we've got the comparison to the figures we've just given, but adjusted earnings per share, it's grown from 17.7p to 21.1p. So it's a steady business. It's doing well. I think it's at a very attractive valuation for what you're getting.
I agree with you. I mean, share price performance doesn't reflect that either.
No. So, I mean, the shares are trading about where they were 5 years ago.
Yes, that's right.
I mean, it's up a fair bit since 2010, but in the last 5 years, it's not really moved.
No, that's right.
And considering that, like I said, I mean, profit and earnings have increased quite nicely in that period, I think it looks very attractive.
Will you be buying some?
Possibly. I wouldn't rule it out. So I've already got Hargreaves, but I think it's not really a direct competitor. So I possibly would have a wealth manager in there, but then I don't know if I'd go with Brewin Dolphin, because Rathbones and Schroders, they all look quite attractive. So I'd probably be looking at one of those three, just because they're the three that I actually follow and I'm quite familiar with. That's not to say there aren't other good ones out there as well, but I'd certainly consider it. It's on the watch list.
For sure. Yeah, no, I'd consider it. I'd definitely put it on the watch list. Absolutely. I think it looks, and I'd probably have a closer look at Rathbones and Schroders too, because it was Schroders not so long ago that we were talking about, and they got to tie up more recently with Lloyd's as well. I think they're all, it's an attractive sector. I suppose the risk to it, whether it's, disruptors could come in there, but because they do have quite handsome margins.
They do, yeah. I mean, in terms of size, Schroders I think that's worth about, last time I looked, it was worth about 7.5 billion, whereas this is 800 million. Rathbones, I checked earlier, it's about the same size as Brewin Dolphin, actually.
I suppose Schroders as well. Depends what you think about families being involved in the business, but I think they still have some of the original Schroder family on the board.
I've read earlier in the year, Niall Ferguson's basically history of the Rothschilds family and the Schroders Bank. They do pop up towards the end in that quite a bit, actually. Just a bit of trivia, in case anyone cares.
Yeah, brilliant. And no. And I mean, if you look at the sort of purely share prices, not directly in terms of sort of businesses, but I mean, Schroders, it's about where it was 5 years ago as well. So from a share price point of view,
Schroders, considering historically how long they've been around for and what a big player they used to be in the 19th and 20th century, they're not that big, really.
They're not. I mean, a market cap of over 8 billion, but yeah, I hear what you're saying in comparison.
I suppose they fared better than Rothschilds and Barings did. So.
Yeah, they're still going, and they've still got the family on the board as well. So that's saying something.
Yeah, Rothschilds are still going, actually. They're just not what they were. They're just a lot smaller.
Yeah. And I suppose, well,
we all know what happened to Barings.
A couple of 100 years of history as well in between times. So
next up, shall we do Britvic?
So Britvic, maker of Robinson's Fruit Shoots to J2O, they've reported a small rise in full year pre-tax profits from 110 10.2 million to 111.2 this year, as lower costs have helped to offset a revenue decline. But overall, the picture wasn't quite so rosy, and the increase in home consumption wasn't quite enough to bridge the shortfall that has been caused by COVID-19 and the closure of bars and restaurants. They also reported a 22.6% decrease in adjusted operating income from the year to the September the 30th to 165.8 million, but revenues falling 8.6%. But the company's been in relatively robust form coming into the pandemic, and sales been up 1.4% in the first half. But yeah, like I said, lockdown since in the second, or I suppose third quarter, in the second half, revenues down 16.3% in the third quarter, and improving slightly to 11.3% in the final 3 months, with some of the restrictions that we have here in the UK being eased and some of the bars and pubs being allowed to reopen. But overall, given the circumstances that we're in, it hasn't been too bad for Britvic, and some of the brands that you would potentially have more at home, like your Robinsons and 7-Ups, rather than the mixers, have held up all right. To me, they seem like quite good results in the circumstances. I don't know what your thoughts are, Sam.
Yeah, I liked it. Probably liked it more than I probably expected. So I thought the CEO's comments were quite interesting. Do you want me to just go through those?
Yeah, go for it.
Yeah, so CEO Simon Litherland said, "While none of us would have wished for the challenging circumstances 2020 has brought, I'm very proud of how we've responded as a business and delivered the priorities we set ourselves at the start of the pandemic. Our determined and dedicated people, portfolio of trusted brands, strong commercial relationships, and operational agility mean we've performed strongly where we have been able to compete. We also continue to navigate the changing landscape successfully. So even though out-of-home trading has inevitably been impacted, we've continued to gain market share in our key growth markets of GB and Brazil. And we've successfully protected cash and our overall financial strength. At the same time, we've also made considerable progress executing our strategy, and we are well positioned to drive future growth and returns. We've extended our GB carbonates relationship with PepsiCo to 2040 and expanded our presence in the energy category through the acquisition of their Rockstar brand. We have accelerated our sustainable business commitments and completed the disposal of non-core assets in France, which will result in more focus on growing our higher margin brands there. While 2021 will bring continued uncertainty, it also presents real opportunity for Britvic to capitalise on the trends which have accelerated as a result of the pandemic. We're confident that we will continue to react with agility and pace as events unfold. Soft drinks has repeatedly proved itself to be a highly resilient category, and we fully intend to be at the forefront of its recovery." I think there's a couple of points of interest in there. The first one is the extension of the PepsiCo contract, which is very important for valuing the business. And the second one is the acquisition of Rockstar. If you remember when we talked about AG Bar, they'd actually lost Rockstar to Britvic. So AG Bar, I think from memory, Rockstar made up about 7% of their revenue. It'll be much
quite
smaller.
Significant.
Yeah, it'll be smaller for Britvic because it's a larger company. But I guess if Britvic were already doing all the other PepsiCo stuff, it's not that much of a surprise, really, is it?
No, that's right. And I don't think that Britvic had an energy drink. They had Gatorade, but not sort of one of the high caffeine drinks. So it makes sense in their portfolio to have that.
Just to go through some of the brands as well. They've got 7-Up, Club Mixers, Club Orange, Drench, Fruit Shoot, Gatorade, J2O, Mountain Dew, Pepsi Max, Robinsons, Tango. Those are just the ones that jumped out at me, really. But it's a strong portfolio of brands.
No, that's right. And I suppose defensive by nature as well. And even when people aren't able to go out, as we've had in the lockdowns, they've still performed relatively well too, which says a lot about those brands.
And I mean, the best comparison, it'd be AG Bar, I think, wouldn't it? They're both doing the same thing. I know Britvic's a lot larger, but I thought Britvic looked the better business. If I was picking between the two, I'd definitely go with Britvic.
No, that's right. And it is a bigger company as well. It's over 2 billion in terms of market cap. Even when we had sort of the sugar tax going back a few years, it still performed very well.
But I know it's 4 times the size. the PE ratios are actually quite similar for Britvic and AG Bar. And I just think when Britvic's got such higher quality brands and it's got so many of them, I don't know why you'd pick AG Bar out of the two, really.
I suppose AG Bar, it's got a country backing it. Scotland drinks Iron Brew.
Well, yeah, but a lot of people drink Pepsi.
You don't need a 20-year Pepsi deal for that, do you? No. I'm being facetious.
If I was picking,
what
I'd be going with Britvic.
But just in terms of valuation, so it's price to earnings, it's about 18 at the moment. What do you think of it from sort of a value perspective?
Well, it's not cheap, but it's not extortionate either. I think you're getting a good business for that 18. What's the dividend yield on it? Do you know?
I think it's about 2.5%, but
so I mean, you get. I suppose the dividend's not that good actually, but I mean, you are paying for a quality business, I think.
Yeah, and they've got operations in Brazil as well, so you've got potentially some more growth going on there.
What I liked about it as well was I liked the fact that they did the dividend on a payout ratio, so it's just 50% of profits.
Yeah.
What I quite like about that is if the business isn't doing as well, the dividend goes down in proportion. You don't end up with a situation where management are trying to sustain the dividend, even if it's not in the best interest of the business.
Yeah, and there are probably quite a few FTSE 100 companies that you can think of that are in that position.
Yeah.
They have been forced to cut dividends over the COVID or the last 9 months.
Yeah, so I thought it's not cheap, but you're paying up for a quality business with some quality brands. And I know not all the brands are their own, but when they're locked in until 2040, it's long enough to do well out of them.
Yeah, no, absolutely. So is it one that you consider?
It possibly is, actually. I like it a lot more than I expected. It's not a company I would have looked at if it wasn't for this. But no, I like it. And if I wanted a soft drink maker, I'd definitely be picking Britvic over AG Bar. What about you?
Yeah, no, I'd definitely consider it. I suppose it would be a good tonic to go with your Diageo.
Exactly. Diageo and Fruit Shoot.
Yeah, well, I wouldn't say Fruit Shoot, but you've got plenty of other mixers in there that you could have your Diageo with. Could have your Tanqueray gin with some Britvic tonic water, probably.
Not the Fruit Shoot, though.
Not the Fruit Shoot.
Right, so should we move on to AO World? So they're the consumer electronics retailer. I think they're pretty much all online, aren't they? They don't have any stores. So it's your white goods,
I don't think
really.
so. I think they might have depots, but yeah, your white goods.
Your white goods, so your washing machines, your TVs, that sort of stuff. So they have released their half-year results. So they reported strong revenue growth, with total revenue for the period increasing 53.2% to 717 million. That's up from 468 million in 2019, which they've said demonstrated their ability to deliver sustained growth in demand in the UK and in Germany. They've announced an increase in group adjusted EBITDA to 28.8 million, up from 1 million in 2019. And they said the EBITDA margin has increased to 4%, up from 0.2% last year, which they've said reflects their ability to leverage efficiencies with scale. The group profit before tax increased to 18.3 million from a loss of 5.9 million last year. Cash generated for the period was 78.4 million, which was up from 5.3 million last year. They've said they've continued to delight their customers in this period of step change increases in volume and COVID-19 operational challenges. Their net promoter score is a consistently high level of over 80 in the UK and Germany. They've said they've had resilient operational performance. Ongoing significant investment in their people and infrastructure ensures they are well equipped to serve the step change in online penetration. AO Germany is on track to achieve monthly profitability on an adjusted EBITDA basis during their peak trading period, and they expect it to be profitable from 2022 onwards. UK revenue was up 53.9%, 606 million. Germany revenue was up 85.2% to 100 million. So that's total revenue of 717 million. So the Germany part of the business makes up about a seventh of revenue. Basic earnings per share were 3.45 pence, which was an increase from a loss of 1 pence per share last year. So their CEO and founder, John Roberts, who, in case anyone is interested, actually went to my school. He was in a different year group to me. I think he was about 20 years prior to me. Oh, as well, the head office is in Bolton.
Oh, wow. Claim to fame.
Exactly. Put Bolton on the map. So AO founder and chief executive John Roberts said, "This has been a half year like no other. I believe our market has changed as a result forever. Online is now the dominant retail channel for customers and manufacturers alike. And I'm delighted by how our AOers have risen to the challenge of this structural shift in behaviour. We have grown share across all categories, and the results we're announcing today give huge confidence that our business is well set for the future to cement the changes. Our growth rates have increased from Q2 to Q3 as we unlock capacity constraints. We've taken huge strides forward on our commitment to fix all the fundamentals of our European business, and we now have a profitable platform from which to accelerate our growth in Germany and beyond. I would like to thank all AOers and our trading partners for making such structural change possible in such a short period of time. It's been an incredible team effort to serve customers, existing and new, in their moments of need, that I believe they will repay us with loyal custom for years to come. Now really is our time, and we are investing to win and cement the change." So, John, what are your thoughts on those results?
I mean, they're very good results. I don't think there's anybody could question that. And the share price, likewise, is up about 3 times over the last 12 months, but particularly accelerated the last 6 months with COVID and people online shopping, upgrading their houses, potentially getting some new white goods in. And AO seems to be one of the cheapest providers on the market for that. But while it's not a tiny company with a market cap of 1.6 billion, you think, does it have much of a moat, and can it sustain this going forward with the really big online retailers in the market, like your Amazons, for example? I'm not sure that it can, but that's not taking away from what it's done so far. So for that reason, it wouldn't be something that I'd be considering for my own portfolio right now. But, you know, you could have said that 6 months ago or a year ago, and you'd have been proved wrong.
One thing that I thought was quite interesting was the CEO's comments that he thinks customers will repay them with loyalty for years to come. I think that's quite optimistic.
Yeah. I mean, speaking from my own experience with these sorts of things, if you were looking for a washing machine, dishwasher, you probably go onto a price, or you may well go onto a price comparison website, and you choose whatever's cheapest within reason. I don't personally have any loyalty to where I get my white goods from.
I mean, you don't see anyone saying, "Oh, well, you know, it's cheaper on Amazon, but I'm an AOer." It just doesn't happen, does it?
Yeah, that's right. And it's not, I mean, Amazon, you've got the sort of the Prime subscription, you've got lots of other services you get through it, you've got very slick app, customer service. If you need to return something, they're usually quite straightforward. I don't know whether certainly in terms of the app and Prime, you don't have anything like that with AO. The customer service may be reasonable, but I don't know. I don't see that brand loyalty, to be quite honest. And considering these are purchases that you might make every few years as well, I wouldn't have thought there'd be a lot to cement that loyalty either.
I thought as well, it is worth remembering a lot of their traditional competitors were not able to operate at the same capacity they've been able to, not under normal circumstances. So a lot of competitors' stores were closed for parts of the year, and as well as that, when they were open, it was reduced capacity because of they had to be COVID compliant. Yeah. And even when they were COVID compliant, there was probably less people that wanted to go because they didn't want to go out if they didn't need to.
Yeah.
So whilst they've increased market share, I don't know whether or not they will be able to retain it. They could do, but you know, once a lot of the competitors are back up and running and under normal circumstances, I think a lot of people will go back.
Yeah, I suppose that's true. I don't know how some of their competitors on the high street would fare. I mean, if some of them go under as a result of the measures that have been taken in the last 6 months, then it could benefit AO. But if I were buying a stock like this, I'd want to be buying it and not constantly having to check it and be confident that it, you know, going forward, you could almost forget about it. And I just don't think AO is that type of business.
No, I mean, like you say, it's a very, you know, they are impressive results, but the other thing is like the valuation. I found it quite difficult to come up with what I thought was a fair valuation for this business, because I know that the revenue is increasing at quite, 53.2%, but the profit it's not got a price to earnings because it's still growing, and it's very, very difficult. And I don't know how big they can get. And I don't know if the growth rate's going to slow, but it's a low margin business. So even though it's growing quickly, how profitable is it going to be? And when it's already valued at 1.6 billion, that valuation, that could be spot on. It could be undervalued, but I struggle to value it. So for that reason, I probably wouldn't be interested in it.
Yeah. No, I mean, like you say, good results, but I don't think it's probably one that either of us would seriously consider.
No, I don't think so. It's doing well.
We could come back in 6 months and it could have, another 3 times. So you don't know, but to be honest, no, I don't think so.
If it carried on growing to the point where it actually had a price to earnings ratio that was usable, I wouldn't mind paying a higher price if I knew what I was getting. That's not to say I'd want to go into the industry anyway, but at least I'd be able to understand it and, come up with a valuation a bit better. Just wait and see, really.
Yeah. No. All right. Okay. So what have we got next on the list, Sam?
So our final company is Dell. So Dell has reported their Q3 earnings this week, or last week, I should say. And their revenues on a non-GAAP basis were up 3% year on year to 23.52 billion, which beat analyst estimates by 7.3%. Their product revenues stayed at 17.35 billion. However, services revenues increased 10% year over year to 6.13 billion. So they make up about a quarter of the business. Recurring revenues, which includes deferred revenue amortization, utility, and as a service delivered as part of Dell on-demand service, was roughly 6 billion, up 13% year on year. Infrastructure Solutions Group revenues were down 4% year on year to 8.02 billion. Commercial revenues increased 5% year over year to 8.78 billion. Moreover, consumer revenues were up 14% to 3.5 billion. Based on orders, the consumer direct business was up 47%, with consumer direct online business up 62% in the reported quarter. Non-GAAP gross profit remained flat at 7.77 billion. Gross margin contracted to 33%. Adjusted EBITDA was up 13% year over year to 3.23 billion. I should add as well, I should have said at the start, but all these figures are in dollars, not pounds. Non-GAAP operating income was 2.73 billion, which was up 12% from the quarter a year ago. Operating margin was up to 12%, and the operating income from VMware, which is a publicly traded company which Dell has an over 80% stake in, increased 18% year over year to 837 million. The company have said they expect fourth quarter revenues to increase in the 3 to 4% range. They plan to reduce their core debt by approximately 5.5 billion in 2021, of which 2.4 billion is expected to pay in the fourth quarter of 2020. So, John, what were your thoughts on Dell?
Well, it's a business I'm familiar with the products of, but I didn't really know very much about. And from the sounds of it, it's something I'd be more interested in now, reading a bit more about it than I would have been, if you'd mentioned it to me last week. And it has different parts of the business as well, like VMware. I wasn't aware that came under, or Dell had, an over 80% stake in. And that sounds like a fast growing part of the business with lots of, practically sort of useful pieces of software that might be used in the business sector. And then from a consumer point of view, it's also got brands like Alienware, again, which I had no idea that Dell owned or ran. So the numbers look good. I mean, what did you say the free cash flow was?
Oh, so I didn't actually, that was off air, but yeah, so I was having a look at the income statements for the past 5 years, and they were all over the place, really. So there wasn't really any consistency, and I was struggling to really get a grip of it. So I had a look at the cash flow instead, and that's much cleaner. 4 of the past 5 years, they've generated free cash flow of over 5 billion, which for a company valued at
about 50 billion, I think.
Yeah,
it is, was
50,
it?
Just under 52 billion. That's impressive.
No, it's very impressive. I mean, is it something that you'd be interested in? And are there any sort of risks or downsides to the business that you see?
I don't know if I'd go as far as say I'd be interested, but I'm certainly be more interested having had a look at it. So it's trading at a PE ratio of 21.8, but on a free cash flow basis, it's closer to 10 or 11. It's not paying a dividend. The balance sheet is interesting as well, actually. So it's got total assets of 119 billion, but it's got net assets of about 50 billion, which is pretty much equal to the value of the business. But included in that total assets is an 80.4% stake in VMware, which we won't go into it in too much detail, but it's an American software company which provides cloud computing and virtualization software and services. And it has a market cap of 58.96 billion. And like you say, it's still growing quite nicely. Dell's stake of that is worth 47 billion alone. They could sell that and pay off all the debt.
Right, and it's a bit like, and it's a bit like that with some of the other big tech companies. They'll have the faster growing parts of the business are often in sort of cloud services, and you can see that with Dell. And I wasn't aware that Dell had that, but that's sort of, to me, that makes Dell a more interesting proposition than I had thought previously. Did you have any thoughts on VMware in particular? Had you dived into that anymore?
It's not a company I was particularly familiar with. It's just the sheer size of it that surprised me, and the fact that Dell owns 80%, and the fact it's publicly listed, and it's whilst being 80% owned by Dell, which is also publicly listed.
Yeah, no, absolutely. Absolutely. And in terms of competitors to Dell, I suppose there are quite a lot. I mean, you think traditionally of a company like HP.
Yeah, so HP, that's got a value of $30.5 billion. The PE for that, it's, according to Yahoo Finance, it's 11. So Dell is the pricier of the two. Let's see what the cash flow is on it though. HP, it's got cash flows of about, over the last 5 years, it's just averaged over 3.5 billion. So I get it's fairly similar in the cash flows are probably about 10% of the market cap. It's not like I looked at it and it seemed like a screaming buy, but it looked interesting.
No, I agreed. I think it's probably one that we'll revisit. We'll dig into a bit further. And in the US section of the podcast, it could be an interesting.
Yeah, no, I'd be happy to come and look at it again. It does seem to warrant further research, I think.
Yes.
Of the 5 companies that we have covered today, so Aviva, Brewin Dolphin, Britvic, AO World, and Dell. If you had to buy one, which one would you be buying?
I would probably, given my portfolio at the moment and that I have quite a lot of consumer goods, I'd probably go for Brewin Dolphin in terms of the UK stock. If it was between the UK and US, I'd be interested in looking a bit more into Dell, but that's not to say I don't like Britvic, but it's just I've got a lot of consumer goods already. But otherwise, Britvic would probably be a pick between Britvic and Brewin Dolphin, I think. What about for you, Sam?
Fairly similar. So I'd like, of the 5 we looked at, I think Dell looked interesting, but it would need more research. Britvic and Brewin both looked, I liked both of them. I'd probably go with Brewin Dolphin though. I just thought a PE of 13, dividend yield of 5.3%, and the growth's quite nice. And it's, I just liked it. So I think Brewin would pick it for me.
Yeah, brilliant. Well, thanks for listening, and we'll see you next time.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.